Welcome back. Quiet for the markets. It's our personal finance segment now, and our expert Hemant Rustagi joins us. We almost had our caller online, but technology is playing hooky. So let me read out his question to you, which came to us by SMS. Well, the caller is Srihari Raju, and he has sent us his SMS from Gurgaon. He asks, what are the factors that investors need to keep in mind for earning tax-efficient returns from their investments, I would assume? Hemant, that's quite a broad question.
Well, I think usually there are two types of investors. There are those who plan their investment very well and those who invest in a haphazard manner. So I think an important aspect of investment, which is often ignored by both the types of investor, is the tax efficiency of return. That's the reason why we see that the traditional options like bank fixed deposit, bond, debentures, and small savings schemes continue to be mainstay of the portfolio of a large number of investors in both the category. By doing so, investors not only compromise on the return that they get, but also the post-tax returns are much lower. But I think that's why it's very important for investors to realize that the tax efficiency of return has to be given due importance, because that makes a huge difference to what they get to keep at the end. There are three important factors that investors need to keep in mind. One, they must invest in investment options which provide tax-efficient return. That's where I think mutual funds score over other investment options. Now, for example, if you look at the debt side, even if a bank fixed deposit and bond fund gives the same return, the fact that the long-term capital gain is taxed at a concession rate of 10%, the post-tax returns are much higher. Similarly, on the equity side also, even though the tax benefits are same for investing directly into stocks and through mutual fund, a mutual fund investor gets a benefit because if a fund manager sells an investment within 12 months, the mutual fund investor is not required to pay any tax, whereas a direct investment will attract a short-term capital gain of 15%. Second thing is, while investing in the tax investment option also, investors need to choose the right option. There are three options which are available to investors: dividend payout, dividend reinvestment, and growth. So anyone who is investing for the long term should be looking at growth option. But I think they need to be a little careful while investing for a shorter duration, let's say within, a year, 12 months. For example, the dividend distribution tax on debt fund is 25%. So which means that someone who is in the highest tax bracket of 30% should choose dividend distribution, dividend payout, whereas investors who are in the tax bracket of 10 and 20% should opt for growth option. Last but not the least, I think investors need to minimize the portfolio turnover, which means that they need to avoid buying and selling at random, because many times we see investors overreacting to market conditions. So if they honor their commitment, time commitment which they have for their portfolio, if they continue to keep investing or remain invested for their defined time horizon, I think they can minimize their tax incidence a lot. So which is very important again for investors to understand that rebalancing is one strategy which can help them in ensuring that they rebalance their portfolio once a year, which means that their post-tax returns can be much better. So I think these are three factors that investors need to keep in mind while earning tax-efficient return. But as I said in the beginning, tax efficiency of investment returns is very, very important for any type of investor.
All right, Hemant. Thanks very much for joining in and giving us all those insights today. But do remember that if you have any personal finance queries, you can send us an SMS, type YM followed by a space and your question and send it to 51818. That's all the time we have on this edition of Markets and Macros. Business Lunch is up next with the top stories.